And here we go. We're going to start broadcasting. Thanks so much for being here and
Yeah, thank you.
presentation. Here we go. Hi, everyone. Welcome. We're just waiting just a moment to allow some attendees into the virtual space before we get started tonight. All right, I think we'll begin. Good evening, everyone. Officially, my name is Carrie, and I'm part of the programming team at the Westport Library. And I'd like to welcome you all to our program this evening, The Pitfalls of Mutual Funds and Annuities with Tim Baker. Tim is the founder and CEO of Metric Financial and is a registered investment advisor dedicated to helping clients lower costs and improve results through factor investing. Prior to starting Metric, Mr. Baker held product development and strategy roles at several firms, including, among others, BlackRock, iShares. There he held numerous roles, including product strategist in the firm's Smart Beta Exchange Traded Fund Group. He graduated from University of Wisconsin-Madison with a degree in poli-sci, and he's a chartered financial analyst and has experience in the financial industry dating back to 1996. Please feel free to put any questions that you might have for Tim tonight in the chat box. We are leaving the chat feature open, so you can feel free to write questions as they come up for you, and Tim will address them throughout the presentation. So without further ado, I will turn the presentation over to Tim. Thank you so much for being here.
Thank you, Carrie. Thanks for having me. And thank you, everybody, for taking your evening. I'm going to share my screen now, hopefully. Yep. And we'll get the chat open in case there are any questions. Okay. So again, thank you all for joining us. As Carrie mentioned, the purpose of this is to really help people understand what are some of the pitfalls of very common investments and income streams out there, particularly mutual funds and annuities. Just a little bit about Metric. I started the firm in 2018. And really the whole idea was I had spent about 25 years in the industry, primarily working with salespeople to help tell investment stories to financial advisors. And over time, I really started to learn that this industry is built for itself, not necessarily for the clients. The industry is just riddled with fees that nobody can see. And so what we really want to do is improve transparency. Really help people understand what it is they're getting into, where some leaks might be, and I'll come back to that in a little bit. So we will cover how financial advisors are compensated. There are a couple of basic structures. Then we'll look at some of the fees in the industry, as well as the challenges, not just for mutual funds, but also for things like annuities, which the industry is very into telling people, hey, we'll give you a guaranteed income stream. People hear the word guaranteed and flock to it. And we'll talk about what some of the challenges are that come along with that. And then obviously, I always tell my kids, if you don't have a solution, you're not presenting a problem, you're just complaining. So we will actually propose some solutions, some ways that we handle things to help improve things for investors, retirees, for really anybody's financial goals. So with that in mind, I'll start with mutual funds and financial advisors. In my view, you can't really start this conversation without understanding what a fiduciary really is. I won't read this whole thing, but to me, basically a fiduciary is somebody that has no conflicts of interest, meaning you can't accept any commissions for anything. You can't have any reason for putting an investment into a client's account or portfolio without it being a direct benefit to the client. You can't receive any other compensation or benefit for putting it into the client's account. This is kind of an interesting area here, and one that has frustrated me. I've had conversations with potential clients where they've told me that their advisor says that they're a fiduciary. and then I look at the person's portfolio and it's filled with A shares of mutual funds, which I'll talk about in just a moment. Those A shares have commissions inside of them, so there's a direct benefit to the advisor for putting those funds into the portfolio. And so I spoke with my compliance consultant and was disappointed to learn that somebody can call themselves a fiduciary as long as they disclose their conflicts of interest. And to me, that's a little like telling you, you're going to drive the car off the lot and all the wheels are going to fall off. But I told you it was going to happen, so it's okay for me to do that. So again, I'll talk about that in a little bit. But so that's kind of the baseline for what is a fiduciary. There should be no conflicts of interest whatsoever. There should be no benefit to the advisor for making a recommendation. We'll cover two basic models. There are a number of different models to the way financial advisors work, but as you know, the title of this presentation is Pitfalls of Mutual Funds and Annuities. So we'll address those compensation structures where mutual funds are involved. And basically, advisors can either work on a commission or they can charge a fee directly to their client. To me, the fee structure, the fee-only structure is really the only way to be a fiduciary. As I mentioned earlier, if you're a fiduciary, you can't charge any commissions. So with that in mind, just a quick description of what a commission-based advisor is. There's a commission charged with each transaction, whether you're buying a mutual fund, a stock, a bond, whatever it is, there's a commission every time a transaction is conducted. It could be a fee that's paid to them by the client, meaning if they're trading stocks and the client pays the commission, or it could be paid to them by the investment company. And I'll come back to that in just a moment again. Could encourage higher levels of trading, right? I think that model is pretty antiquated. Not a lot of advisors out there that are still trading stocks in order to earn commissions, but it does still exist. Again, cannot be a fiduciary, and if you're earning a commission, you cannot charge a fee, meaning if somebody's using commission-based products in your portfolio, they can't charge an advisory fee on top of that. There's a huge potential to lead to a lack of disclosure and attention. It's really important, particularly as we talk about the commission structure, right? Once somebody earns a commission from a transaction, what's their incentive to ever reach out to the client again or do anything on an ongoing basis, right? I just earned my commission and now I'm on to the next client or next potential client. So we put that question at the bottom, how many people know what a mutual fund share class is? So let's dig right into that. I was shocked. So I started my career as an advisor working for Smith Barney. Actually, it was Solomon Smith Barney, for those of you that remember that firm, which is long since gone. It is now called Morgan Stanley. A shares were rampant at the time. When I came back to the industry 25 years later, I just assumed that those things were dead, excuse me, because I spent so much time in product strategy and development, and there was so much sort of bad blood around things like A shares. I just assumed they had gone away, particularly when it comes to the regulators that really don't like these types of things. So as you can see there, A shares, that's a share class of a mutual fund. So if you have XYZ mutual fund, it could have an A share, it could have a C share, it could have an institutional share. The A share is really the most expensive and really to me is the most burdensome on the client because it does involve a very heavy upfront commission, and that comes directly out of the client's portfolio. So you can see there that the front load or the front commission on a mutual fund, an A share, is 5.75%. So if you give an advisor $100,000, $94,250 goes to work that day. The advisor keeps the $5,750. It takes a lot to claw back out of that, especially when you throw on top of that, you see that 1.04% fee. That's an ongoing annual fee. So not only have you had 5.75% of your portfolio taken out on day one, you're still paying that additional 1.04% on an ongoing basis. These fees are not disclosed anywhere. I always tell people you're not at fault for knowing how expensive these mutual funds are. They're just not disclosed anywhere. It's something we would love to change with the industry, but metrics gonna have to get a lot bigger before we can go down and influence the SEC to force that. The annual advisory fee is actually included inside of the 1.04%. I note it only because people should understand that that fee continues to come out and pay the advisor or the advisor's firm for continuing to hold that mutual fund. The rest of the 1.04% goes to the mutual fund company, whether it's portfolio managers, the company itself for administering the fund. So really what I did was I took the 5.75%, divided it by 10, and added it to the 1.04%. So if you hold a mutual fund over a 10-year period, an A share, you're paying 1.66% of your portfolio's assets just for owning that mutual fund. And again, you may and may not get service along the way because, again, the advisor has already earned that upfront commission. This structure is very common at firms like Ameriprise, Edward Jones, and frankly, it's a big favorite for advisors who like to be able to say, we don't charge a fee. So one of the accounts that we earned very early on, I asked if I could take a look at some of the fees that were being charged in the portfolio, and the client said to me, well, they don't charge us any fees. The account happened to be with Edward Jones. And my response was, when did Edward Jones become a branch of the Red Cross, right? They're not in this for charity, they're earning money, and you really have to look under the hood to find out what it is they're charging. So basically, an advisor in this situation can say, we don't charge a fee because they're not charging an actual advisory fee. They have a very expensive mutual fund that pays them through that fund. So that's the way A shares work. I think it's starting to become more common. Advisors that use the institutional share class. You see, I put in quotes, institutional shares are cheaper, but they're still much more expensive than some of the alternatives that we're going to talk about. And they're accompanied by an advisory fee. So this is really important to us because it's something that so many people just have no idea what's going on inside of the portfolio. Maybe the advisor is disclosing what their fee is, although a lot of advisors won't do that unless they're asked. And frankly, a lot of people don't know which questions to ask. We actually have a video on our website that says 5 questions to ask of any financial advisor. And it does get into a lot of, hey, let me understand better what all the fees are that are coming out of my portfolio, what I call leakage, right? So if you think about the return that you could be getting from your portfolio, how much is that return reduced by all of the fees that are coming out of your account? So the average large cap mutual fund institutional share class has an expense ratio of 0.7%. As you can see, that's lower than the 1.04% on the A shares. But as we'll talk about in a little bit, 0.7% is still very expensive, especially when you add it on top of the average advisor starting fee is 1.18%. So again, I've calculated what is a 10-year cost to the investor or the client, and you're paying almost 2% of your portfolio's assets to have an advisor build a portfolio. And for the most part, places like Merrill Lynch, Morgan Stanley, UBS, a lot of them are not, the advisor is not actually building the portfolio. There's a home office that's doing it. So one of the questions that we have in our video is, what are you actually doing for the fee that I'm paying you? Your home office is building the portfolio. You're not building a financial plan for me. What is it exactly I'm paying the 1.18%? These fee structures are typically declining. So the more you have under management with them, those things will decline. But even when you get over $1 million in assets under management, the average advisor is still charging over 1%. And again, using these mutual funds with very high expense ratios on them. So again, you can see you're paying almost 2% of the value of your portfolio. Put simply, the S&P 500 goes up 10% and your portfolio loses out to that and goes up a little over 8%. So really, in terms of reaching financial goals, retirement, education, a new home, whatever it might be, a lot of what you're getting out of the financial industry is just a huge drag on the portfolio with fees that are really designed to pay themselves. And the lack of transparency is, right, the less people know, the better it is for the industry. And they can just keep earning their fees and nobody's any the wiser. So those are really the two structures. So why are mutual funds so expensive? Mutual funds were great 40, 50 years ago when they were the only game in town, because it was a way to get a well-diversified portfolio of stocks or bonds or whatever it was that you wanted to have in your portfolio. And we'll talk about some of the evolution that's gone on in the industry. But they have very high upfront commissions, as we've talked about. Even no load funds, meaning funds that do not have that upfront sales commission, they have some very high embedded administrative and distribution costs. So that 0.25% that I referenced on the A share, that's what we call a distribution fee. And that gets paid either to the advisor or to the advisor's firm. And frankly, I mean, in my view, there's no other way to put it. That is basically pay to play. Will continue to pay us just for having us on your platform. Active funds, which is most of the mutual fund industry, have very highly paid portfolio management teams. I worked with portfolio management teams at BlackRock, where portfolio managers were earning 5, 10, 20, even higher than that, $1 million a year, and then paying these very large research teams in order to pick all of the stocks that they're going to put in the portfolio. And as we'll talk about in a little bit, picking those stocks is actually generally not a good thing. It's been proven. There's all kinds of academic research. If anybody wants to see it, I'm more than happy to share it. That picking those stocks is not a good way to outperform the market. And in fact, if anybody's familiar with Vanguard, I assume everybody is. Jack Bogle was the gentleman who started Vanguard. And frankly, his whole view of the world was you're paying all of these really high fees to portfolio managers to beat the market, and they're not doing it. So stop paying those fees and just own the market. And we'll talk about sort of a different way to think about that. There are ways to beat the market, but picking individual stocks is generally not the way to do it. Also, very high administrative costs. Anytime somebody buys a mutual fund, the mutual fund company is required to mail out a prospectus to that investor. If you redeem a mutual fund, there's a cost to redeeming those mutual funds on behalf of the client and actually sending them money or depositing money into their account, whatever it might be. There's a very high cost associated with that. And just a little bit of foreshadowing, if anybody's familiar with exchange traded funds or ETFs, those don't have those redemptions and purchases. You just trade, as the name would imply, you just trade the fund on an exchange, and there's no need for the mutual fund company to do any kind of redemptions. So those are really the main fees that keep expenses very high for mutual funds. So what do you get for all of those fees? And this is sort of part one of that. You can Google this yourself. SPIVA, Standard & Poor's Index versus Active. This is a very real study. For those of you that are familiar with Standard & Poor's, like the S&P 500, same company. Every 6 months, they run a very lengthy report that describes how portfolio managers or how mutual funds fare against a broader market index. So rather than repeat the whole 60-page report here, I've taken out the most relevant sort of benchmark index and said, okay, in that report, we talk about the percent of large cap mutual fund managers and how they fare relative to the S&P 500. And there are a couple of important pieces to this. Number one, as you can see from this chart, this is the percent of large cap mutual fund managers that underperform the S&P 500. This is what the SPIVA study is tracking. And in my opinion, these are some pretty damning numbers. If you look out over a 20-year period, so in the long run, how does my mutual fund do relative to the market? And you can see here over 90% of those managers underperform the market in the long run. Again, going back to Jack Bogle's philosophy, most of these managers are not beating the market. So why are we paying all of these high fees to them to do exactly that? The other important piece is The industry is very good at selling itself as, yeah, but look at my track record. Look how I've done over the last 3 years, or look at how I've done over the last 5 years. So in addition to figuring out what percent of managers are underperforming the market in the long run, they also run what's called their persistent scorecard. So even if you do take managers that are doing well relative to the market or to their peer group. So when we say in the top quartile, that's what we mean. How are they doing relative to their peer group? If you go to June 30, 2021, which is the last time the persistent scorecard was updated, if you looked at all of the managers that were in the top quartile 2 years ago, meaning go to June 30th, 2019, all of the managers that were in the top quartile of their peer group, 2 years later, how many were still in that top quartile? And you can see that number is less than 5%. So I always tell people to be very careful about when an advisor or a mutual fund company is really pumping up their recent returns, because that's probably a pretty good sign that they're not going to have good returns over the next 2 or 3 years. So again, we run everything on data. We don't do anything on marketing or product sales. If the data is there, we follow it. And the data is very strong against actively managed mutual funds. Again, very high fees, and they're not even doing what they're supposed to do, which is beat the market. Excuse me. Okay, let's talk briefly about annuities. I think everybody's probably familiar with what annuities are. They are basically an annuity company and an insurance company will come in and say, okay, you've amassed this wealth over time. Excuse me, turn that wealth into an annuity and we will build an income stream for you. What doesn't get shared a lot, other than a very long, lengthy, legally worded prospectus, is all of the fees that get buried into those annuities and really hamper investor returns. Variable annuities, fixed annuities, it doesn't matter. All of these fees are really a huge drag on the client. So I'm not going to go into all of these. This is a fairly complicated slide, but I really wanted to just kind of pick on 3 of these things. Number one, beware of anybody selling an annuity. They are going to earn a commission for it. The industry is getting better at creating what's called fee-based annuities, where there are not upfront commissions. We're nowhere near anywhere evolved in that way. Pretty much every annuity that gets sold nowadays is going to involve an upfront commission for the advisor. And that fee, that commission, we'll just call it 7% on fixed annuities. That's one of the more common types that's out there now. So you put $100,000 into a fixed annuity, that advisor is getting a $7,000 check that day. So what's an offshoot of the commission embedded in these annuities? You get what's called surrender charges. Whoops, sorry. So surrender charges. So if you put $100,000 into an annuity, generally speaking, you can't touch that money again for anywhere from 7 to 10 years. And the reason for that is the annuity company has to earn back the commission that they just paid to the advisor, right? If they give the advisor a 7% commission and you turn around and liquidate your annuity, well, then the insurance company just lost 7% of the value of the portfolio. So they put in place what's called a surrender schedule. So if you take your money out in year 1, you can have 93% of the money. If you take it out in year 2, you can have 94%, so on and so forth. And eventually, after anywhere from 7 to 10 years, you can actually access your money again. And then the third one I want to point out is the investment fee. So particularly for folks that use variable annuities, these fees can be extremely high. And what they do is they basically bury A shares inside of an annuity. And the reason that they do that is that's how the advisor gets paid. So if they're not going to get an upfront commission on a variable annuity, they will use very expensive mutual funds inside of the annuity. In fact, if you were to dig through a prospectus, you would see many annuities have share classes created just for them. So you'll see what's called a VA share class, a variable annuity share class inside of the mutual fund. And they basically take the same mutual fund you might buy from somewhere else, put it into this annuity, and give it a much higher expense ratio with a higher fee that can go to the investment advisor. And I've looked through a number of prospectuses in my career, and you can find mutual funds in there with expense ratios north of 1.5%, depending on the asset class. And it really is just a huge drag on the investor's ability to grow their funds. And the last one, the mortality fee is going to apply to almost any annuity. That's just a fee that they put in there for them taking the risk that you're going to live too long. And it can be anywhere from 0.5% to 1.5% of the value of the portfolio. And it just gets automatically deducted from the annuity every year. So really very high, very complicated, and very low transparency fee structures that are embedded inside of these annuities. So why would people buy them, right? The number one word that comes to mind is guaranteed. And it's something I hear all the time. In fact, I spoke with an individual not too long ago who said, yeah, I understand I'm going to get a lower return, but it's guaranteed. I'm guaranteed not to lose any money. If anybody would like it, I wrote a very long email about this I send out a weekly email to a distribution list. And I sent out an email about this a long time ago, explaining why an annuity company would be willing to guarantee you a return. So if you look at something like a fixed indexed annuity, they will guarantee you that you'll never have a negative return, but they're also going to cap your return, meaning you'll never get a negative return. Your baseline is 0, but you can never earn more than 4% or 3%, whatever the cap might be. And if you look at the returns of the market in the long run, the annuity company is winning every single time by giving you that cap, because the average return for the S&P 500 is 8%, and there are very few negative 5 or 10 year periods in the S&P 500 going back historically. So basically, they're keeping 4% every year and giving you 4% when you could have been getting 8. And so the challenge there is, folks go, well, I like the guarantee, but especially if you have a longer window, a longer investment horizon, accepting that guarantee in exchange for what could be very good returns generally does not work in the favor of the client. There's something in Q&A. Okay, standard of living, Ray, annuities not factored in, address please. Yeah, so the standard of living with annuities, there is always a way to get what's called the cost of living adjustment. So with regard to annuities, you can always pay up. So an annuity will generally pay out a flat income stream. So let's say you annuitize your annuity and the annuity company agrees to give you $1,000 a month. That's flat. But inside, there's always what's called riders inside of an annuity. So you could pay an extra 0.5% in order to receive cost of living adjustments. And they would set some kind of a number like, we'll give you $1,000 a month for the first year. The next year we'll increase that by 2%. The following year we'll increase that by 2%. But again, it's something that has to get paid up for it. It's something that has to be included in what's called a rider in order to earn that cost of living adjustment. Otherwise, it's just going to be a flat rate. The other thing I would say, and I'm going to talk about this a little bit more when I get to alternatives to annuities, you can build your own income stream or have an advisor do it for you, however comfortable you are doing it on your own versus having somebody do it for you. You can build an income stream out of a portfolio with traditional investment classes where you get a much better standard of living increase just by owning traditional asset classes, but still keeping money safe to generate your income. So that's a great question. The standard of living piece is very important. You can get cost of living adjustments, but they will charge an extra fee in order to offer those cost of living adjustments. So thank you for that. The other thing that is often surprising. I don't know if there's anybody on this presentation that owns an annuity, but I find that people are often surprised by the fact that once you start to draw the income stream from the annuity, it's called annuitizing it. So let's say you own a variable annuity for 20 years, it builds up to $500,000, and then at year 20, year 10, however long it is that you've owned it, you go to the annuity company and say, okay, I'm ready to annuitize. What's my rate? How much are you going to pay me every month? And then sign the contract, and you're now annuitizing or receiving an income stream from the annuity. Your principal is essentially gone at that point. There are some annuities that will allow you to access a certain percentage, certain percentage of the assets that were originally in the portfolio. That number will decline every year, right? The annuity company's not dumb. We can't pay you an income stream and still make the principal available to you. So basically the principal stops growing again, to that person's point. If you pay for the standard of living increase, the value of the income will continue to increase, but not the value of the portfolio. And in the event of death, unlike, let's say, an IRA, a 401k, a traditional brokerage account, where in the event of death, the beneficiary receives the principal and then can decide what they want to do with that principal. With the annuity, the beneficiary can only receive the income stream, not the principal. And that can be a challenge, right? If you have somebody that's younger and inherits, an annuity from, a parent that passes away or whatever it might be, that younger person, excuse me, a frog in my throat tonight, that younger person may not need that income stream and might prefer to inherit the principal. And in that case, they could continue to grow the principal for themselves and future beneficiaries and that sort of thing. That is not the case with an annuity. They can only inherit the income stream. Excuse me. And so as you can see down below that, there's a couple of challenges there. Well, those two last things are related. Number one, very little flexibility with regard to the monthly payments. So when you go to an annuity company and say, I'm ready to annuitize, and if anybody owns a 403B, you've been through this before, places like TIAA-CREF, they will set up an annuity and they'll basically say, okay, well, what flavor do you want? Do you want the income stream to last for 10 years? If so, we'll pay you a 6% interest rate. If you want it to last for a lifetime, we'll pay you a 4% interest rate. If you want it to last your lifetime and a spouse or beneficiary, we'll pay you a 3.5% interest rate, right? The longer you're going to take that annuity stream over, the lower the interest rate or the rate that they're going to apply to your principal, the lower that rate is going to be. And the other challenge that's related to that, because you don't have flexibility with regard to the amount of those monthly payments, is it can often force somebody into an unwanted tax bracket. So we have a client that joined us in 2019. He had $1 million worth of annuities. We ran the income plan that I'm going to show everybody in just a few minutes. We ran the income plan and realized that once he turned on those annuities, once he annuitized those annuities, they were going to be generating a whole bunch of income that he didn't need. And so therefore he gets pushed into a tax bracket that he doesn't need to be in, and therefore is just paying the government extra money every year when the money could be continuing to grow for himself or his beneficiaries. So those are a few really big challenges with annuities, and we do encourage folks to consider alternatives, and we'll provide at least one in a couple of moments. So this is kind of one of my favorite things. If anybody hasn't picked up on it yet, I'm kind of anti-industry. There are a lot of things that go on in the financial industry that are really geared for itself as opposed to the clients. So in exchange for your fees, what do you get? Predictions, right? Turn on CNBC. If you have an account with Ameriprise, Merrill Lynch, any of those firms, they're constantly sending out research. This is where we think the S&P 500 is going to be by the end of 2022. This is where we think the 10-year treasury is going. This is what we think is going to happen to the price of oil. And again, anybody who wants to see the academic research, There has been a lot of academic research put together on stock analysts and economists and how often they're right. And it's a little worse than a coin flip. So they tend to be right about 49% of the time. One of our sort of founding principles is we don't make predictions. We do everything that we do based on a client's timeline. So if somebody comes to us and says they're going to retire in 10 years, we're going to create an asset allocation and we're not going to worry about what the stock market does tomorrow, the next day, next month, 6 months from now. Trying to predict those things is futile. I mean, literally, if you go over the last couple of weeks, if anybody's paying attention to the market, we've been up 1%, down 1%, up 1%, down 1%. You know, trying to predict these things. You know, you look at yesterday afternoon was a great example. Stocks really started to sell off late into the session and closed at their lows at 4 o'clock yesterday afternoon. And sure enough, we got almost all of it back today. The market was up close to 1%. The NASDAQ was up over 1%. So I won't beat it to death, but predictions are just, they're not useful. And as somebody who worked at BlackRock and the Hartford and a number of other firms like Citigroup, these people make a lot of money to not be right, basically. Product development, like alternatives and hedge funds, the value of a hedge fund to me is very, very low. In fact, if you read what most hedge funds are designed to do, they're designed to generate a return with low volatility. And so most of them tend to have returns that are lower than the market in the long run. And they have very, 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 very high fees, like outside of the ordinary mutual fund or annuity, very high fees. When I worked at BlackRock, one of my counterparts worked in the alternatives department, and they had a mutual fund that they were launching. And I asked about the fees, and he said 1.5%. And I said 1.5% expense ratio, and he said no, 1.5% management fee. So management fee is one of those costs that's embedded inside of a mutual fund. So BlackRock, just the management team was keeping 1.5%. The total portfolio expense ratio was 2%. So these things have extremely high expense ratios, and they're really not even designed to outperform the market. They're designed to generate lower volatility. You can get that out of a bond portfolio, a mix of stocks and bonds, a mix of stocks and bonds and cash. You can create that stream of returns for yourself without paying all of those fees. Promises of better performance. That is what this industry is built around. It's all built around marketing and product development and telling people you're going to pay us these fees, and in exchange for that, we're going to beat the market. And as we already talked about, they just don't. And then the other piece is sales conferences and award trips. If you ever walk into somebody's office at Merrill Lynch or Morgan Stanley or Ameriprise, they have these big plaques on their wall, Directors Club, President's Club, you know, and that probably means that that person got a free golf trip with their family to Kiowa Island or something like that. That costs money, and clients are paying for that. So again, just another way that the industry is using fees coming out of the client's investments to really reward itself. So what are some alternatives? I will try to go through this in a pretty efficient manner. The alternative to mutual funds, frankly, is exchange traded funds. And I've heard a number of different conversations, advisors that say exchange traded funds are new, they're not mature, they're volatile, and it's just not true. The first exchange traded fund was started in 1989 by State Street. It's called SPY. It's an S&P 500 tracking exchange traded fund. It is enormous, it's diverse, it's extremely well traded, it's very low cost, and the industry has been doing nothing but developing more exchange traded funds ever since that. Similar to mutual funds, they're very well diversified. If somebody tries to tell you ETFs are volatile, it just depends on what's inside it. So one of the ETFs that we use in our portfolio is FLOT. You can Google it. It's an exchange traded fund that invests in very low volatility short-term bonds. It moves very little. In fact, it's designed to not move much when interest rates move. On the other hand, we own VOO, which is a Vanguard S&P 500 ETF. that has the same volatility as the S&P 500 or any other mutual fund that's tracking the S&P 500. We own an ETF called MTUM that is tracking momentum, and I'll talk about that, what momentum is, in just a moment. But they're no more volatile than any other mutual fund, or it all depends on what's inside of the exchange traded fund of the mutual fund. And by the way, mutual funds are way more transparent than a mutual fund. If you go look up VOO, which is the Vanguard S&P 500 ETF that I just referenced, on Vanguard's website, you can see all of the portfolio holdings as of yesterday. That is not the case with a mutual fund. While there are active ETFs, the vast majority of them track an index, and that's why they tend to be very low cost, is because there is no portfolio management and research team trying to pick stocks. They're just tracking an index, and that's very easy and low cost to do. I won't get into too much detail on this. I do have a paper on my website if anybody wants it. Carrie, maybe I'll email it to you afterwards, that explains why ETFs are so low cost and why they're so tax efficient. It's something called the in-kind structure. And all that means is if somebody liquidates an ETF, instead of the portfolio manager having to sell a bunch of stocks to meet that redemption, all the portfolio manager has to do is exchange a basket of stocks for another share of the ETF, or vice versa, depending on which way the trade is going. And I know that sounds complicated, but at the end of the day, all that means is there was no sale that happened inside of the exchange traded fund. There was what's called an in-kind transfer. The ETF is considered an in-kind transfer for the basket of underlying stocks. And so they're very, very tax efficient, and I'll give you some proof and some data on that in a moment. Also, ETFs have no share classes, so advisors can't get paid for them as a standalone. No advisor could come to you and say, I built this portfolio of ETFs for you, and I'm not charging you a fee, because ETFs don't have distribution fees inside of them. So it also gets to a disclosure issue, which is there's nothing to disclose. For an advisor that's using a portfolio of ETFs like we do, we charge a fee directly to our clients, and then we use ETFs and we don't get paid another penny from anybody except for our clients, as opposed to mutual funds where the advisor can get paid a fee directly by the client, and there might be money that's going to that advisor's fee from the underlying fund. So that's a very, very, very quick primer on what exchange traded funds are. But so we'll just talk a little bit about the alternative to mutual funds is ETFs. The alternative to active managers trying to pick stocks is academics. There's something called factor investing that is also all over my website. So if you look at the traditional advisor website, it's somebody in a boat or standing on a beach or whatever it is, and here's where we're going to get you. Everything on our website is designed to educate people, and a lot of it is around these factors. And so without getting too technical or academic, a factor is basically a characteristic of a stock that academics, not marketing people, PhDs outside of Wall Street, have done decades and decades and decades of research on and proven that these characteristics of stocks will outperform a simple market in the long run. So they're simple things that you've heard of before. I think everybody here has probably heard of a value fund. So there's value stocks, cheap stocks that do better than expensive stocks in the long run. Size, smaller company stocks tend to do better than large company stocks in the long run. Momentum, the closest approximation you could make for a momentum portfolio would be like a growth portfolio. But in this case, it's very, in fact, the academics say growth is not a factor. Momentum is the factor. And momentum is basically, if you have a stock price that's doing better than the market over a certain period of time, it will likely to continue to do that just because of investor behavior, right? Investors see things going up and then they go buy them and then they keep going up. Bitcoin's a great example of that. High quality company stocks tend to do better than low quality stocks. And contrary to what a lot of folks might think, low volatility stocks. So the textbook sort of mantra in the industry is, well, you have to buy stocks because if you want a higher return, you have to take more risk, which is true. But within the stock market, you can actually get a better return by owning lower volatility stocks than higher volatility stocks in the long run. And a lot of that has to do with protection on the downside. Low volatility stocks did very well in 2008. And so they had a lot less to recover from relative to some stocks that were higher volatility and did worse in a period like 2008 and early 2009. So again, this is not designed to be an academic lecture on what factors are. I only give that as a baseline to talk about why they would be considered an alternative for actively managed mutual funds. So as I noted earlier, a little over 90% of active managers underperform the S&P 500. And what we're showing you here is a comparison of global factor indexes relative to a global basket of stocks. Couple of challenges here, because the astute ones are looking at this and saying, well, if that light blue line is global stocks, sure, momentum, quality, and low volatility look great relative to that. Value and size don't look so great relative to that. And so it's very important to understand what happened during COVID and how much short-term returns can impact long-term returns when there's a lot of magnitude to it. So value and size did horribly in 2020. In fact, you had the biggest gap between growth and value stocks in 2020 than you've ever seen in the history of the stock market, because everything shut down, right? Hotel stocks, oil stocks, bank stocks, all did horribly. The only things that did well were things like Amazon and Zoom and Netflix. I mean, Netflix killed it because everybody was sitting at home, subscribing to Netflix and watching movies and things like that. So I don't have the data here, but if you look at the much longer term track record of value stocks and smaller stocks, they do as well or better than the market in the long run. But these shorter term numbers, and I know 15 years doesn't seem like a short term number, but COVID has had a massive impact on that. And we're actually starting to see some pretty serious recovery. Value did much better than growth in 2021 as economies started to open up again. But either way, so let's say you have a portfolio that's momentum, value, quality, low volatility, and size. 3 of those 5 factors have still beaten the market in the long run. And the way we weight the portfolio, momentum and quality are actually the biggest holdings in the portfolio anyway. And you can see how well those have fared over a 15-year period. But the point of this is where active managers have failed to beat the market, many, if not all of these factors do outperform the market in the long run. And by the way, just so everybody understands, all of these things are indexes. So that's a momentum index. You take a global basket of stocks and instead of weighting them by their market cap, you weight them by their momentum characteristic or their quality characteristic or their value characteristic. And then you have an ETF that tracks those indexes, just like we talked about earlier. Instead of being actively managed, the vast majority of the ETFs track an index like the S&P 500 or like momentum or quality, whatever it might be. Okay, so that's the track record on factors. So let's talk about taxes. And we actually have a very fresh in our mind example of how this works. We just brought in a new client. The client was owned mutual funds on his own, no advisor, at a number of different firms like T. Rowe Price and Vanguard and American Funds, places like that. And he showed me a spreadsheet of all of the income that he was getting. $60,000 a year of his taxable income was actually capital gains that were getting kicked off by these mutual funds that he owned outside of IRAs. And so I explained this to him. So a tax cost ratio is essentially how much your return is reduced by having to pay taxes, capital gains taxes, distributions from mutual funds. And you can see that they absolutely dwarf these these are actual, now I'm not talking about indexes anymore, I'm talking about the actual ETFs themselves. So if you look at American Funds, Growth Fund of America, 5-year tax cost ratio of 1.8%, 0.4 for a comparable factor ETF, 0.4%. I won't go through every single one of them. You can see across the board, the exchange traded funds are significantly more tax efficient. And it goes back to what we talked about earlier, that structure of the ETF. They don't kick off capital gains distributions. You'll pay a capital gain if you sell the ETF, but if you just hold an ETF, it will not kick you off unwanted capital gains distributions every year. So this particular client that just signed on, he's going to take a fairly significant capital gain this year by getting rid of all of those mutual funds, selling all of them. But now his capital gain tax bill going forward is going to be much closer to zero. So the tax efficiency of exchange traded funds is another great reason why mutual funds have just become antiquated. And by the way, we also have information on our website that shows how much money has left mutual funds over the last 10 years. And it's all basically gone directly to exchange traded funds, particularly in the stock space. So that is tax efficiency. So I told Carrie, I know this wasn't designed to be an advertisement or anything. I just want to show folks how much this can impact. So if you think about costs as leaks in your financial goals, as I mentioned earlier, our crusade here is really to create better transparency and educate investors. And as I mentioned, we started with a fee schedule that's about 36% lower than the industry average. So if you look at the portfolio of ETFs that we use, the weighted average cost of the ETFs is 0.16%. Let's remember that that number for a mutual fund was 0.7%. So literally a fraction of the cost, and most likely getting better performance than the actively managed mutual fund, partly because of those fees. That's part of what hurts active mutual fund performance, is the fact that they do have high fees. Beating the benchmark is a really hard thing to do. And the higher your fee, the higher your hurdle for actually beating that benchmark. And then we compare our 0.75% to their 1.18%. That, as I mentioned earlier, many fee schedules are designed to decline after a certain level. So not only did we start our fee schedule significantly lower than everybody else's, we also set a very early, what we call breakpoint, meaning instead of saying we're going to charge 0.75 on the first 2 million of assets and then it declines, we charge it on the first 500,000 and then it starts to decline. But so the point of all of that was fixing or reducing leaks. So that little quote there from Benjamin Franklin is actually on the homepage of our website. Beware of little expenses, a small leak will sink a great ship. So at the end of the day, when you combine the cost of the investments and the advisory fee, you're paying a little bit less than half of what the traditional financial advisor would charge and their mutual funds. So there are opportunities to eliminate a lot of these costs. I'll come back in a moment to talk about how we help folks do this. But it's a really important thing for folks to think about. One of the things we show people, particularly people that work with financial advisors, we do kind of a what's your number thing, meaning forget about performance. Let's say our factors are no better than an actively managed mutual fund. If you got the same return from two portfolios and reduced these fees over here, 10 years from now, how much more money would you have available in your portfolio? And it's really an eye-opening thing for investors to see how much those costs really are a drag on portfolios. The alternative to annuities, so all of that was the alternative to mutual funds, actively managed mutual funds, is, as I mentioned earlier, you can just create an income plan. We do this for clients all the time, particularly folks that are within 2 or 3 years of retirement. And it's a pretty straightforward process. You determine a floor, meaning how much money do I know I'm going to have coming in during retirement? Social Security, I have a pension, I have a rental property, all kinds of things like that. And then I need to figure out what are my expenses or income needs, right? Those two things are not the same. Expenses are basically what it costs you to live your life every month. Income needs might be something above and beyond that because, well, I don't just want to pay my bills. I also want to set aside some money to travel, or I want to buy a boat, or whatever it might be. And then what's the gap between that income floor, Social Security, pension, all those things. What's the gap between that and the income needs? And basically you fill in that gap with withdrawals from your investment portfolio. And there really is no 60-40 rule. Again, this newer client that came on board, he was blown away when I suggested his portfolio should be 90-10, 90% stocks and 10% bonds. But the reason for that is he's very high net worth and he has very low income needs. So where the industry likes to talk about 60-40 and you have to have more bonds because you're getting closer to retirement, because you're getting older, none of that should matter. What should matter in terms of determining how your portfolio is allocated among stocks, bonds, and cash should really be driven by needs, not just some arbitrary timeline. And the big key is, in addition to being able to manage your taxable income, as I mentioned earlier, annuities can often throw people into a tax bracket they don't need to be in. You keep and grow your principal instead of turning it over to the insurance company. So somebody has $1 million portfolio, and again, they annuitize it. Nobody ever gets anything but that income stream again. Whereas when you build your own kind of income plan, and I'll give a couple of samples in a second, in the event of death and a beneficiary is inheriting the money, let's say that person is 40 years old, 45 years old, they have no need for this $1,000 a month because they're still working. Now they take control of the portfolio and invest it for their future. So you actually get to keep and grow your principal instead of turning it over to them. So just a couple of examples of how that works. Basically, best practice is to keep about 5 years worth of income needs in cash and bonds. Let the rest grow. There's obviously an emotional element here too. One of the big things we tell clients is, here's where we think you should be. You tell us where you would feel more comfortable. So if I say 90-10 and you say, yeah, but I don't want that volatility, we might agree on 80-20 or 70-30. So again, there's the data versus the emotion. And then you simply rebalance it annually. No matter what the markets are doing, you always make sure you maintain that proper allocation to make sure that your income for the next couple of years is guaranteed. So client number one has $48,000 in Social Security coming in, $20,000 pension. They need $90,000 a year. So 90,000 minus 68,000 is, you have a $22,000 gap. That means they need $22,000 a year coming out of their portfolio. The client has a portfolio value of 1 million. So the client's gap, the $22,000 as a percent of the portfolio value, they need 2.2% of their value. Obviously, this is an illustration. Taxes need to come into play, all of those things. This is simply just to simplify the data. So that person, right, would need to be a 90-10, right? So 10% of the portfolio would get you at least close to 5 years worth of income in cash and bonds. Contrary for client two, who has less coming in terms of income, right? 30,000 in Social Security, 18,000 in rental income from a property. They need $60,000 a year. Their gap is only $12,000 as opposed to $22,000 for client one, but their portfolio is only worth $300,000. So even though they have a lower income need, they have a smaller portfolio, so the gap is higher as a percent of the portfolio value. That client should actually be an 80-20, even though they have less income needs, because 20%, right, divided by 4, you get to 5 years worth of income in cash and bonds. And again, just rebalancing that every year, no matter what, to make sure the income is guaranteed, and always trust that in the long run, the portfolio value is continuing to grow for what's not being kept in safe havens like cash and bonds. So that's the alternative to annuities. Final thoughts here. You know, we think a little bit less traditionally than the industry. You know, I always tell my kids one of my least favorite things is, this is the way we've always done it. Right? I mean, you could point to a million examples of things that this is the way we've always done it is not the best way to handle things. So what we try to encourage people to do is think about the evolution of the industry. And that's probably our biggest complaint about Wall Street is the investment managers like BlackRock, like Vanguard, like Fidelity, they tend to evolve. Advisors tend not to. Advisors tend to keep fees that remain stubbornly high. They tend to continue to use mutual funds because there's a benefit to them for doing so. The parent company earns money from it. They have strong relationships with these mutual fund companies, but that doesn't mean that the client has no other alternatives. And again, we acknowledge relationships are difficult to upset. Our very first big client came to us less than a year after we started the company. He was with Merrill Lynch for 10 years. We did his "What's your number?" The number was about 194,000 in how much extra he would have in the portfolio in 10 years. That was a difficult relationship for him to upset, but it was clearly worth it to him. And again, minimizing drags or leaks, it just leads to a better outcome for the client. I mentioned earlier, we talk about how we do this for clients. One of the things we're doing to incentivize folks is we started what's called our Financial Advisor Charity Challenge. So for anybody that goes through the process with us, regardless of whether or not they do business with us, and that's where I was going with the whole relationship thing, even if people don't want to come do business with us, the big thing for us is at least you can go into it with eyes open and say, okay, I did this study, I did this analysis of what's in my portfolio, I'm aware of all of my fees and expenses, but I'm going to choose to stay where I am anyway, as opposed to just going with things because this is the way we've always done it. So regardless of whether anybody makes a change or not, just for going through the process with us, we'll make a charitable donation to the charity of somebody. And obviously there's no cost, no commitment. We wouldn't make a charitable donation if we were actually charging money for doing it. So no cost and no commitment for doing any of that. So I'll just make everybody stare at my disclosures for a second because my compliance person would want me to do so. A lot of this information is also available on our website. Carrie, I'm going to flip over to sort of how people can contact us if they would like, and we could open it for additional questions if anybody has them. I don't know if people can get their mics turned on or they just want to do it by chat and Q&A. Any thoughts or questions about any of this or anything else? What's going on with the Fed? What's going on with interest rates? What's going on with inflation? Any questions that anybody has?
Yeah, so feel free to write any questions. And unfortunately, because it's a webinar, we can't invite people to speak or come on camera. But feel free to write any questions you might have for Tim in the Q&A or in the chat. Any comments? Looks like you must have covered everything.
But my joke is always, if I don't get any questions, I said all the exact right things or covered the exact right amount of data. By the way, anybody who is interested, I do have, and Carrie, maybe I'll include this just as a little extra thing because we didn't talk about it here. I was on Connecticut Public Radio recently with actually a very famous academic talking about inflation, how it impacts clients, what we're hearing from clients, what it means for the Federal Reserve. If anybody would like to listen to that interview with Connecticut Public Radio, happy to share that as well.
Sure, I'm happy to, you can email that to me and I can send that out to everyone who attended tonight. Happy to do that.
Terrific. Thank you.
All right.
Well, everybody who joined us, we appreciate your time.
Yeah, thanks so much, Tim. This was great. It really, really thorough information. So appreciate your time. Feel free, those of you that attended tonight, to contact Tim. And you can also feel free to contact me at the library if you have any questions or would like any other, any other topics that Tim might be able to cover in this kind of business realm. We can certainly have some discussions around that as well. So thank you so much for being here. Thanks to everyone for coming, and have a great night. Thanks, Tim.
Thanks, Carrie.